Hello and welcome, everyone. My name is Ray Barretto. I am the Director of Client Services and Business Development here at CSI, a Moody's Analytics company. I'm pleased to welcome you to this webinar, Understanding Investor Psychology, Behavioral Finance in Action. Now, before we begin, there are some housekeeping rules I need to provide. Today's webinar is being recorded. The ratings, financial reporting analysis, projections, and other observations constituting part of the information contained herein are and must be construed solely as statements of opinion and not statements of fact or recommendations to purchase, sell, or hold any securities. We ask that no one record this webinar without Moody's explicit written permission. Lastly, no one has permission to quote any of the comments made or questions asked by the webinar audience. All members of the audience are currently on mute. If you have a question, please type it in the Q&A box. Hello and welcome again to today's webinar on Understanding Investor Psychology, Behavioral Finance in Action. I'm thrilled to be your moderator today. Whether you're a financial advisor or someone simply curious about the psychological factors influencing financial decisions, you're in the right place. Before we dive into today's topics, I'd like to extend a warm welcome to all of you for joining us. We appreciate you taking the time to be here and engaging with us on this fascinating subject. Behavioral finance is a field of study that combines psychology and economics to explore why people often make certain financial decisions. Traditional finance theories assume that people are rational actors, always making decisions that maximize their utility. However, behavioral finance acknowledges that emotions, biases, and cognitive errors can lead to irrational and suboptimal decisions. In today's session, we'll explore how these psychological factors influence financial behavior and how we can become more aware of them to improve and strengthen our advisor-client relationships. Next slide. Apologies. Joining us today for this important discussion is first Brian Paslich. Brian is the Chief Executive Officer and co-founder of Behave Technologies. Brian provides technology solutions, consulting, and research to ultimately design and help grow stronger, deeper, and more profitable advisor-client relationships. Brian has coached, trained, and supported more than 1,000 financial advisors, earning Top Advisor Retention Leader and Top Recruiter Award multiple times consecutively. Additionally, he serves as a senior mentor with the Founder Institute NYC in Seattle and Silicon Valley, where he has mentored more than 20 cohorts and 300 founders during his past 8 years. Before he entered the world of finance, Brian served as a flight paramedic with the U.S. Army Reserve and 2 SWAT teams. Next, we are joined by Don Lefren. Don has 20 years of financial services experience in capital markets and wealth management. His work experience encompasses derivatives trading, risk management, and alternative investment research. Don currently works at one of the key Canadian banks where he focuses on strategic advice and practice excellence. He obtained his CFA and is the co-founder and co-chair of AIMA Canada's Sales Practice Committee for a number of years. Thank you both for joining us. Next slide. Brian, I'm going to ask you the first question. I was on your website recently and I immediately was drawn to some of the statements mentioned. They were empowering people to make optimal decisions, empowering individuals to better understand their decision-making, bridging the gap between intention and outcomes, shortening the trust cycle and nurturing deeper, more impactful and profitable client relationships. And lastly, the one that I liked the best, which was handle the complexity so clients can execute simply and efficiently. My 2 questions to you are, what is behavioral finance and why does it matter? And the second question is, how do we really make decisions?
Well, good morning, good afternoon, and thanks for reading. The first thing I've noted is I've got to change that bio because that's an old one I have and makes me sound like I've done a lot and I'm an old guy now, which I guess I am turning into that. But good morning, excited to be with you today. And, you know, this would be what I would call one of my favorite subjects. Ever since I was young, for me, it's been important to really understand people. I've always been that curious kid. I think at age 2, I never grew up from. I joke that I know more about my partner's mother-in-law than my partner because I'm always asking questions. I get teased that I'm nosy, but I'm just curious. I'm always curious about why people do what they do, how they think, and really trying to understand them. And one thing I want to preface it with, we're going to talk about behavioral finance, but I want to break it down very simply. It's in the last 20 plus years of managing principal with teams, we put together these great plans. Clients say, yep, that sounds good, let's do it. And then all of a sudden there's a breakdown. And so for me, it really started to understand, why do we do what we do? Not from a good, bad, right, or wrong. See, a lot of times we like to be prescriptive and we like to fix, right? That's just human nature to help people. But there's a great thing of us being irrational, doing the things that we do. It's the reason that we put someone on the moon. It's the reason that we fly planes. Because if we look at what we had for logic, we probably wouldn't do half the things that we did. So let's get started. Next slide. So with that, really, when you break it down and understanding why people do what they do, we can have all the data in the world, but there's two things that we're missing. That's behavior and intent. That's really the why, right? And so for me, it's really about understanding two parts. One, it's breaking it down for myself when I'm engaging, because if I come in with my own set of beliefs and behaviors, and I'm expecting Rui to do something and it doesn't end up that way, it can lead to some friction, right? Which obviously it often does with us in relationships. That said, it's first of all, why do they do what they do? And it's in a non-judgmental way, right? So if I can understand why he's making that decision, why it may not agree, or why not have been what he said he would do, just to simply understand. The second is to really help the client understand how they think. And so there's two main areas in this, and understanding the why is really the first is what we call the intention action gap, right? We say X, we do Y. We say that we want to do this, and I want to get you all to play along with me for a second. I'd like you to challenge this and say yes while shaking your head no. Yes, and then no, because that's exactly what a lot of times clients do for us. Rui comes in and he's my advisor, and I say, you know what, Rui, sure, I'll save. I look at him and say, sure, I'll save. I'm not going to spend. I'm going to put that towards my goal. Because this thing that's in between our ears, that's what drives so much of what we do. Next slide. And this is that I've got all the best intentions in the world. I'm going to have the salad. 1 o'clock comes around, I end up having the pizza, right? So what do? We chalk it up, or we blame things like no self-discipline, no clear goals, things like that. And we really get stuck on those things, right? And so we say, all right, here's where you went wrong. Go ahead and let's get you back on plan. Well, then what happens, right? Next slide, please. Really, we've got thousands of decisions that we make each day, upwards of 6,000 plus. In food alone, we can make upwards of 400 decisions. Do I pick up the glass of water? Do I pick up my coffee? Simple things like that. We don't even realize that we're doing that. And we have these thousands of decisions we're made each day. Most of them are made by our lower brain, upwards of 90, 95%. Several hundred behavioral factors in there. These are just a few key ones that I like to use when it comes to financial planning. But this is the first piece, is to understanding the why we do what we do. The second piece, next slide, is what I like to call social desirability bias. I call it first date syndrome, right? We want to make the best first impression. When I'm sitting down, if Rui's my advisor, I'm sitting down in front of him, the first thing that I say is, well, sure, I want to talk about investments or that, not what's going on in my mind. Listen, I'm having a hard time. I'm struggling. I don't know where my money's going. Whatever that may be, we really like to make that best first impression, and that's okay. But how can we break that down to really understand who the real self is and not just the ideal self? And so really, in doing that, these are the two main things that behavioral science simply seeks to do, right? It's just help individuals understand how they think behaviorally, not from a good, bad, right, or wrong when they make decisions, and then really get at the core of what we call the real self. Reduce that social desirability bias. Case in point, I was speaking at a workshop, about 2 years ago, and I had an individual on the panel with me, and he brought up exactly a case on this. So he was sitting down in front of his advisor. He took a risk tolerance. He came back in 85. 2 weeks later, he came back and he was a 71 when he took it at home by himself. I think, Rui, you shared with me a story the other day about that, where, again, we want to look good. And it doesn't mean that, we say ego, all these things. Listen, it's just human nature. We want to be, perceived a certain way. Rui, I'm kind of curious if you're open to sharing that story real quick.
You know what? It's funny that you bring that up, because it wasn't until we actually conversed that I recognized that what I perceive myself in front of one person is not the same as what I perceive myself at home. So I kind of attended my advisor conversation, and we were talking about investing for the future. And in my mind, it was just, go aggressive, because one, I'm somewhat in the industry. I somewhat know what's going on. And the understanding is that because I know what the industry is about, that I should be all aggressive. And so in the eyes of my advisor, who knows what I do for a living, I went all aggressive. And then it wasn't until I got home that I kind of sat back and said, maybe I should have answered those questions slightly different to kind of really talk to what makes me, lose sleep at night. So it did happen, and I'm still trying to kind of figure out how to kind of correct what I've done over the last 5 years as a result of those responses.
And that's the thing. It's again, it's not good or bad, but that's just human nature. That's who we are. And that's why, it's like I know we use behavioral science, behavioral finance a lot, but it's really just understanding humans and how we make decisions, right? How we think. And so next slide, please. So if we really take those two key things down, because at the end of the day, we can get up here and I have a team of very smart PhDs, much smarter than me. I always joke I'm the dumbest one on the team because we have the great science people. But that said, it's really about understanding these things. How can we sit down and run through the client journey and really make an impact, from starting point? And so with that, if you look at the different studies that have been out there for the last almost a decade now, number one thing that comes up time and time again is I wish my advisor understood me better. And so what they mean by that is, do we really spend the time to understand them? 2+ decades ago when I started, we never met online. You and I would sit down face to face, and it was really about having a conversation, getting to know each other. I like to say those are the relationships that were an inch wide, a mile deep. Well, things had changed over time, right? We've eventually moved to digital with COVID. Things kind of get sped up quite a bit. And so now we have these relationships that quite often are inch deep, a mile wide. And so we have to do more with less. And in that shorter time frame, how do we build those deeper connections and engagements? And a lot of times what happens, clients focus more on the investments or the planning side because that's what they think, again, with the ideal self. So we follow suit with that. So it's taking a step back. So if we break it down really to 3 main phases of client engagement, the first one around client acquisition, I like to start with is really setting the stage. And as I mentioned earlier, it's really about going in curious, no judgment, with the goal to simply understand and not be prescriptive at this point, right? And so because if Rui says, all right, here's my problem, we want to go right in and jump and set up versus understanding what the problem is and then the why behind the problem. You do not have to be a behavioral expert, nor do you have to know the first thing of behavioral science. It's just understanding human people. So starting with that point around client engagement. So one of the things that we like to do is really start with, before we jump into goals, values, and the key piece here is whatever that process is that you use. If it's around goal planning, values planning, I grew up with BACRAC, values-based selling, whatever that is, we don't want to change that, but we're starting before. And really, when we look at it, this is where we're building trust. And we sometimes confuse trust and rapport. Rapport are, hey, you like this, I like this. That's important, it's essential, and that does add to trust. But trust really comes from listening. And when I look at listening, I look at 2 different types of listening: factual listening and empathetic listening. And empathetic is really that meaning behind the meaning, right? The why you do what you do. So starting there, and really, before we jump into all the goals, planning, or investments that you're here for today, I'd really like to understand you a little bit better and understand, and that's the piece. While there's great assessments that exist out there that drive a lot of this, a simple conversation to just understand what brought them in here today and tell them a little bit about themselves. It's not on their balance sheet, right? So that's a really key piece as far as client acquisition. And then, again, part of onboarding, right? Today, in today's day and age, we've leveled the playing field. 20 some years ago when I started, we were one of the oldest fee-based planning firms. We had certain funds that others didn't have. So there was those types of things. Today, most everyone can do everything that that the other individual does. So how do you differentiate? It's really about the relationship. And so, part of onboarding, and again, it's not just looking at their bank statements, it's looking at their investment statements, but it's also looking at the why they do what they do. We tend to look at data, demographic, and external data, right? And we can have all the data in the world. The 2 things that it doesn't tell us are behavior and intent. And so let's move on to the next slide really quick. And so what I want to do is break down just a few things you're putting into practice. These are just a couple, behavioral factors that I look at. Whether you have an assessment tool, there are tools that exist out there that can help clients understand how they think behaviorally, or you're just sitting down with a client, understanding some basics before they walk through the door. Sorry, the very first one, overconfidence, right? This is something that hopefully most of us here are on today. If we're in the financial practice, we probably have a healthy level of that. And again, I don't look at something as a good or bad. Someone could have a 0 or someone could have 100 out of 100. It's just who they are and it's how they think. And our belief, or my belief in particular, is unless I'm causing self-harm or harm to others, that's what makes us unique and individual. That's the part of this, being irrational that makes us who we are and creates the things that we do. So in understanding, someone's role, are they in a senior executive role? Are they an entrepreneur? Are they an advisor? They tend to have a more healthy level of overconfidence. So when you're going through the plan with them, when they seem, all right, I know this is it, that's a decision I need to make. It's asking certain questions. Have you made those decisions before in the past? How's that worked for you? Have there been opportunities or times when it hasn't worked? Little questions like that, you can start to get behavioral insight into how they think and make decisions, right? Little things like playing devil's advocate, keeping a decision journal. I love to do this with my team all the time. I call it a pre-mortem. We do a post-mortem a lot, what went wrong after the fact, but a pre-mortem, what can go wrong, right? So little things like that around overconfidence. The next, loss aversion. For so long, we've grouped loss aversion and risk and how we look at it, but they're in fact two separate things. We tend to play 2-to-1 where we prefer not to lose or play to not to lose as opposed to play to win, right? And so little things around that factor as far as when I'm taking that extra risk, am I doubling down trying to recoup, or am I doubling down because it's the right choice? If I'm a portfolio manager, right? The market drops, do I buy because I'm trying to reduce cost basis, or am I trying to capture things, right? If I find myself at that play not to lose or focused on the losses a little bit more when I'm making decisions, I want to stop and think about it. Doesn't mean what I'm doing is right or wrong, but it means if I'm consciously aware of that, right? I joke that we think we're in control, but we're really the rider, and the elephant is our non-conscious brain. And so at the end of the day, it's going to want to go where it goes, and we're along for the ride sometimes. So the more that we bring that from that non-conscious to the front really helps us understand. So that's loss aversion. Situational belief is a big one for me, because quite often we look at someone's situational belief based on their bank statements, their P&L, whatever that may be. They could have $10 million sitting in the bank, but at the end of the day, if they don't feel they're okay, right? Case in point, I grew up, I'm Croatian, so immigrant household. My dad worked his butt off and never throughout his life. He retired 3 times and ended up going back and doing something. Financially, he was fine, but in his mind, he wasn't. That tends to be something that us immigrants have a little bit of, but it's really about understanding it's not what the bank statements or the P&L look like. It's what the individual thinks, right? The final one, future orientation, especially in today's day and age. We've got this darn thing that's in front of us all the time, pushing us with a ton of information and wanting us to do things. Average individual, some studies show roughly 70% of the population has a 1 to 3 year future self, meaning myself, who just turned 50 in May. If Rui, you're talking to me about retirement planning at 65 and I'm supposed to hand you a check for 20,000, that I'm giving that to a stranger, because that's 15 years from now. I have no idea who that is. So it's understanding and starting to put things more in perspective with today. So those are just a few key things that, again, you don't have to be an expert, but when you're sitting down with a client, to think a little bit about, and again, it's understanding the why they do what they do, not trying to fix or, all right, here's your problem, I want to solve it, and be prescriptive.
So I agree with everything you've said, Brian. The one thing I find is that there are advisors who, have great clients and they have great relationships and they know everything about them. And then there's that other group of clients where sometimes you don't necessarily give them that same attention. You don't necessarily have the full understanding of their relationship. How do you find that behavioral finance, especially in this day and age where it went from a soft skill to now behavioral type mindset, changed?
It is. We all like to say we treat every client the same, myself included. And when I built my book, that said, I got to 100 clients as fast as I could, and I would drop the lower 10 and try to find the next. It's just how I built my book. My A clients got a different treatment. I respected them and treated them, gave them the same, but the time and attention, right? That's just human nature and how we do things. I know there's a lot of talk around Dunbar's numbers and the span of relationships, and now digitally we can change it. That said, it's really those that we really know and those that we don't know so well. By understanding certain behavioral aspects of that individual, let's say you and I have more of a transactional relationship and I don't know you, but if I can understand certain behavioral factors, let's say, if I understand that you have a higher loss aversion, the second the market takes a little bit of a correction, right? What do we usually do? We're on the phone. I know some are under the desk, but most of us are on the phone calling our clients. Hey, Rory, remember we talked about the market's going to go up or down? Just want to check in with you, see if it's okay, right? That's what we're going to do with our A clients. Our B and C see, we tend to do this hope and pray that they don't call us. If they do, it becomes a little bit of
Yeah.
a compliance. But what we can do, and some of the things that we're doing right now with individuals or firms, I mean, is that we're actually looking at from a behavioral aspect. If we know certain aspects, loss aversion, situational belief, we can look at those are individuals that we just automatically send out a message. It could be something that you or you could actually have built into the CRM that literally just pushes out a message that says the exact same thing that I would say in person, but sends that out to them. Now, the individual that has good overconfidence, no loss aversion, they have plenty of money in the bank, the situational belief is great. They're in it, let it ride. So you don't have to worry about them. So really, instead of looking at an A, B, and C type of client based on assets or a balance sheet, really looking at it from a behavioral lens and really looking at who are the ones that want this touch versus that touch. Because quite frankly, we know what to say. It's the how, why, and when of what to say.
That's a great approach. Actually, to your point, I think when I was in the industry, the one thing I did is focus on the assets, and the assets drove my segments or my tiers on how I would kind of allocate the time between my clients. But that is a great point to kind of focus on a different perspective. And with that, my next question, Don, this one's for you, is how is client-advisor relationship changing with the introduction of behavioral economics in the financial services space?
Yeah, that's a great question. And thanks for inviting me here today, Rui. And just maybe before I get into that, I give you a little bit more on my background. So I started my career off pretty much in a large bank, but in 1995, a little bit about how I got involved was I got hired into a group or put into a group of that specialized in hedge fund managers. So a lot of what I would do would be due diligence around hedge fund managers, and that included kind of looking at the psychology of how a manager thinks about their investments. And to Brian's point, do they double down? When do they add risk? When do they take risk off? And that kind of led me down a path that later in my career led me to kind of behavioral finance. So I've had kind of many decades of putting managers under the microscope and looking at the way they think and the way they act. And it's very interesting, in terms of the reactions you get and how they all react. And I'd say in 2016, somebody handed me a book on behavioral finance, and I read it and just became more fascinated. And that's what kind of led me down the path into becoming a bit more of a practitioner now, and in terms of where I'm at. In terms of how does it change the client relationship and in introducing behavioral economics, it's probably the single most impactful thing that I think any advisor can do in the industry. If you take a look at the research, and whether that's there's a number of pieces out there. Manulife in 2021 ran a research piece on that. You've got a number of other. Arthur G. Little has done a lot of research around that. You can see that this has a huge impact. There's a lot of positives that kind of come out of behavioral finance, or taking a behaviorally led approach with your clients. Can we go to the next slide? Because I think that kind of summarizes it up. I mean, as Brian kind of talked about, we get below the surface with clients. We have increased loyalty to products. We're communicating to clients in a fashion that's consistent and coherent with the way that they think about making financial decisions. We reduce client turnover. Let's be honest. When we talk about client retention is never a problem until it starts to happen. And often, when the market sinks and advisors start to lose books or clients out of their book, there's another advisor on the other side that's building their book, and we'll talk about that in a little bit. And so, all that has to happen is the client just has to become a little uncomfortable with their advisor. And if there's not the alignment, all of a sudden, in a volatile environment, that may be the catalyst to decide to move their business or consider moving their business. The converse, or the opposite, flip side to that, is obviously that you increase success. So client building your book. This can be a differentiator. So right now, in terms of the Canadian landscape, there are a number of banks that have tried this, but I think really it's in the implementation, right? How do you talk to clients, and how do you engage your clients, and then wrap the whole thing? It's really hard. I can tell you, I've done the work, I've done some research. is really hard in the without having some sort of a diagnostic tool to have those conversations. And we'll get into that in a little bit. But anyway, there's a lot of good things. Let's go to the next slide, because there's some industry statistics that I think that are worth kind of touching on. When we take a look at the value of behavioral advice, we know, and most advisors would know this anyway intuitively, that 94% of financial planning is behavioral management. I mean, let's be honest, clients get nervous, they get skittish when markets aren't cooperating. And a lot of what you're doing is really using your soft skills to kind of make clients feel better. But if we were to quantify that, and there is some research, basically we can show again that there can be as much as 300 basis points in increased returns from qualified advice. We can prevent as much as 200 basis points through kind of missteps financially. And if you talk to and look at advisors, 50+% of advisors can basically attribute to increased client retention. So there you go. I mean, that's data. I've cited all the research down on the page, on the bottom of the page. We can see that 83% of client acquisition in adversity increases. So again, just sort of wrap some number around some of the concepts that I've been talking about. And that really, I think, is what makes it worthwhile. The one question I have actually, and this is for Brian, I mean, anyone that's on the call is probably going, what's in it for me? So Brian, if I take a look at how we implement this, what would you say would be reasonable metrics in terms of what I could expect in terms of the different dimensions to a business or my book?
A great question, Don, and not to go spew a bunch of stats and everything and make promises, but what I will say is this, 99% of the advisors I work with over the last 25 years, the number one thing is bringing on new clients, right? And maintaining relationships and growing that book of business. That's been the challenge that hasn't changed since the day that I started. In a lot of ways, I say if I were to do it over today, I don't know if I would so much, because I do think we had it easier back then because we were face to face, right? And we didn't have so much information in front of us. But really, the differentiation is it actually makes our job easier. And I want to talk a little bit about qualitative and quantitative, right? Because quantitatively, we can talk about stats, we can talk about, increase in wallet share, increase in referrals, increase in all of that. We can get into that in a little bit, but qualitatively, right? Unfortunately, most of us, we go in and we feel like we have to be the SME or the subject matter expert around certain things. And, if Don comes in and asks about investments, I go into an entire conversation around investments. That said, at the end of the day, he was just wanting to make sure, am I going to be okay? In making our job easier, and I joke a lot, but, we think that the more we know, the better off it is, but at the end of the day, the more we know about our clients, and more importantly, the more they know about themselves, the better off it is, because it's not what we know of an individual that's important, because that creates what we call asymmetric engagement. You fill out a form, I have information on you, you're still not on the same page as me. It doesn't matter what I know about you until you understand. That's the only way. And we all say we meet our clients where they are, right? Yes, some do, right? And but a lot of times what happens, do we meet them where they really are, or the ideal you is, right? And so that's the very first question that we need to ask. The second then is like, how do we get better at that? If I can help my clients understand themselves and why they do what they do in a non-judgmental way. This is the key piece, because we do not like to feel bad. That's one of the reasons that we say what you want us to say instead of what's really going on, because we're afraid we're going to be judged whether you do or not. And I can't remember every single conversation I've started. I think it's like, listen, there's no judgment. I want to learn about you. That doesn't matter. It doesn't all of a sudden, okay, fine. And here, let me tell you all the bad stuff, right? It's so much more than that, and little things like even when we sit in an office, where we're at, what the environment looks like, right? Those things impact when someone comes in. Do they give us more of the ideal self or the real self, right? But really understanding the why they do what they do and asking questions, right? It helps to build that trust, because what I see is there's two factors in developing a strong relationship. There's building trust and trust and confidence from our side, but there's also building trust and confidence from the client side. And we tend to be really good at one. Here's why you should work with our firm, our returns, our this, whatever that may be. Where we tend to struggle sometimes, and that's not our fault as an industry, is building trust and confidence in the client, right? So we think financial education, and yes, that is important, but how we deliver that, when we deliver that, why we're delivering that is just important. So how do we build trust and confidence in a client, right? It really starts with reducing uncertainty and fear. We're not trying to make them the product experts. That's why they come to us. But we're really trying to help them to understand why they do what they do without judgment, right? Again, unless they're causing self-harm or harm to others, really that's just who they are, and so the better that we can do that, the better off that we can, build that relationship. But it's starting there, and that empathetic listening, again, why you do it, you then moving from that, into really taking that and looking at, all right, how do we apply that to those decisions going forward and thinking about that? So every time we're sitting down and we're talking about a review of an investment statement or their plan, it's really not just looking at the numbers or the balance sheet and are you on track or not, but looking at what goes on in here, right? And really taking the time. So,
yeah.
Sorry, I can go on forever. Apologize.
No. I don't. I know we're not in the Q&A session just yet, but this one question popped up that I thought would be really great to get both of your opinions on. And we can start with Don, or Brian. We can start with you. Is how do you see AI technology integrating with behavioral finance and the client advisory practices? I think with Copilot, ChatGPT, and everything, how do we take what everybody's using and integrate that into behavioral finance?
Maybe I'll start with that one because I've been on a tour speaking about that. I was actually just up at the PMAC conference. A little shout out to them as well too. And it does say I love compliance, but which I do. It keeps me safe. So, but that said, generative AI, right? That is the buzzword of the day. It's AI in itself has been around for decades. And I think that's something that we, sometimes don't speak enough about. It's very similar, if those who recall, a few years ago, blockchain was the buzzword of the day. Blockchain in itself is amazing technology, right? But it's not the buzzword. It's not the key. It's the hammer of the nail. Same thing with generative AI. What generative AI does is it really frees up a lot of time because today, advisors have to do so much more and with so little time, right? We tend to joke and we say it's more like a swivel chair type of approach to things where you've got so many different systems and everything. You've got to pull all this different information. That's where generative AI can come in. What to remember about generative AI, and I remember back when Robos first came out, all my advisors were like, oh no, we're going to get replaced. It's the end of the world, right? Well, here we are, more than a decade later, and no, we're not, right? They do serve a key piece. Same thing with generative AI. Generative AI is logic-based, right? It's not illogical. It's not irrational. That's human, which is great about us, right? And so that's the first thing that I want to bring up, And so the second it does become illogical, then we may have to go back and watch Terminator movies. But until that point, I think we're pretty safe. But where I look at generative AI is, today and in the future, what it's going to do is it's going to free up our time doing the things that are non-client engagement facing, which is what we want. Right. And for those of you, bear with me for a second, I'm a Star Wars sci-fi geek. So those of you that know or Star Trek, those of you that know Star Trek, any generation, but I look at generative AI in this way. There's two outcomes. If you look at generative AI and Star Trek, right? Star Trek's mission is to meet new people, to engage, to help civilizations, right? Now, generative AI is in the background. It's what gets the ship from point A to point B. It solves complex things faster than any human. It does all the ancillary stuff that allows us to focus on one thing and one thing only. That's human engagement or human alien engagement, however you want to look at it. That's one outcome. Now, I joke, the other outcome is those of you that have kids or are a kid and watch Wall-E, right? Where this is kind of the other potential future, right? Where we're plugged in and these lazy boys running around and it's plugged in. I do think generative AI for us is going to be the Star Trek piece. And the reason why I say that is it's going to remove a lot of the time that we spend doing the things that are non-client facing that allows us to be in the front and be client facing. The things that are missing in AI, right, is empathy, right? Understanding. It's asking the questions. It knows what task. It doesn't know why, what the next question. And so being able to do that, that's where no one can do it better than an individual, right? And I think in a lot of ways, this is where advisors are really going to step up and really have a chance to be more of a financial coach, if you will. But where behavioral fits in, and this is some of the work that we're doing right now, is we like to look at it as generative AI as a one-size-fits-all approach. So there's 563 on the call right now. And right now, if we go on to any financial institution and AI spits out some information, what it'll do is it'll spit it out as we're all going to see the exact same message, right? Now, that may be right. It may not. You know, I like to joke. You could have Shakira, RuPaul, Shaquille O'Neal, and myself in a room, right? And we might look at this and how do we tend to market or engage? We might say, well, there's four distinct markets. We tend to look at external factors, demographics, financial stuff. Behaviorally, we could in fact be the same person. And so this is the key by understanding behavioral, direct engaging, because I can't understand you or build trust unless I ask questions, right? And the only way inferring only gets us so far as we're seeing with data intelligence or data science, right? We still don't know behavior intent. Behavioral science, behavioral finance allows us to engage, to understand, and then from there, apply that framework to generative AI, which really helps to drive a different message. Case in point, my co-founder, Prasad, brilliant quant. He can spend 12, 13 hours on an Excel sheet and smile the whole 12 hours. I think that's a little crazy and should have some, therapy. Now, no offense to any quants. As you can see, I'm a driver, right? Myself, I'm a driver. Big picture and bullets, right? Regulatory focus. Am I prevention or promotion? Is the glass half full or glass half empty? He's very risk focused. I'm very positive abundance mindset. So now if I talk to Prasad and I give him pictures, bullets, and all the positive stuff, guess what happens? In one ear and out the other. I have to give him detail, and I have to start first with worst case scenario, because he's not even glass half empty. He's usually the glass is cracked and got a hole, but it's starting there and really moving forward. Once I do that, now then we can talk about the positive. If you start with me of here's all the stuff in the risk, guess what happens? I've tuned out and I've moved on. And so this is where behavioral engagement with generative AI can really, we actually have a solution we call Empath AI that's really about bringing empathy to AI. But that's really where we see for ongoing engagement, marketing, and education, that's where we can see the combination of the two really making an impact.
Yeah, no, I completely see, which brings me to my next question. This one's for Don. The webinar focuses on behavioral finance, obviously examining biases and investor behaviors with an eye to helping clients make better decisions. But what about behavioral finance macro? Impact on overall stock market movements due to behavioral biases. What are your thoughts on how this calls into question the theory behind efficient market hypothesis? And you're smiling, so, oh, sorry, you're on mute.
On mute, Don. Oh, there we go. Don. Mute. And he just had his best comments. So.
Sorry about that. Yeah, sorry.
It's
It's fantastic thought I had.
Yeah.
The one thing I wanted to say is it's the reason I was smiling is, when you go through a CFA program or an MBA program, we talk about markets being efficient. And when I first got into the business, I was certainly of that thought because that's what they taught you in school. And then, of course, I get into my role in capital markets, and what am I doing? I'm interviewing hedge fund managers that are consistently beating the market and outperforming in many cases, not all. And again, the question is, well, can you consistently beat the market? Well, some can and some can't. That's a discussion for another day, but certainly behavioral adds to it. So just to address the question, there's certainly a macro component to it. There's no doubt. There's people that look at it. And I think today's environment has definitely changed because with program trading and a number of other aspects, there are things that move the market and move the psychology, but people are people at the end of the day. And you got to break it down into kind of what institutions do and then what retail investors do. And it gets kind of complex. But maybe to just tie into the previous question, the one thing I will add is the world is becoming more behavioral. And it's something that as an industry we're working towards. And to touch on Brian's point, behavioral investing is a fantastic way to kind of personalize the way we deliver our services, and then overlay that with AI doing all the grunt work. We can further personalize and automate things. And ultimately, I mean, that's the holy grail, I think, for many institutions, is to be able to personalize things down right down to the individual level. And that's really key. So again, I think it's a little macro and a little micro mixed in.
So it brings me to this next question, and both of you, I'd like to get both of your opinions. Efficient market theory, and we've all heard that in a number of years and a number of suggestions in pretty much anywhere you look. But efficient market theory suggests that markets are rational and reflects all available information. This runs kind of counter to the impact behavioral biases has on market activity. So how would you address that?
Don, you want to start first?
Yeah,
Sure.
no, I'm thinking about it, and I'd have to say this. It's like there's definitely biases, and the one thing that I've learned when I look at interviewing, in over the span of my career, interviewing managers and talking to managers about that. I would say that there's definitely biases that creep in. And the question is, and I always used to ask this of myself, what makes a good trader, right? You get on the floor and you talk to somebody and, we used to sort of say, you're either a good trader or you're not. But we never really addressed what that is. Like what factor does that? One of the things I can say is that, and again, I'm going to take a more practical example to this approach, to the answer, which is, over the years, the one thing I've observed about traders, and let's be honest, traders are different than investors. Investors are long-term, traders are short-term. So again, I want to make that distinction. But the best traders actually have an ability to kind of take themselves out of the picture and kind of re-examine and then reinsert, come up with some decisions, and then kind of go in fresh. Often when you have a star trader that isn't working out well, they pull them out of the lineup. Sometimes some managers have a rule where they lose a certain amount of money, and guess what? The trader's just told, take the next 2 or 3 weeks off, get your head straight, and then come back and start trading again. So I think there's a lot of aspects that we can kind of integrate both behaviorally into the way we think about investing. And again, as Brian pointed out earlier, it's about awareness, right? If you're aware of certain things and biases that you bring into the investment process, then you have an ability to kind of check, because some of these things are totally non-conscious. We don't think about these things. So if you have a degree of awareness, again, that allows you to kind of take that step back.
I think to that point, I'll add is, if we talk about Markowitz, I won't go down that path, but what he actually does versus, speaks. And this is so often we see, if we look at let's take any stock, right? Amazon in my backyard and where my partner works. Each individual there has their own behaviors from the CEO on down, so at the end of the day, we can look at P&L, we can look at every different, quantitative aspect of it, right? But understanding the qualitative really has a directional impact. And I with this, especially with the democratization around trading, right? We look at the GameStop craze that happened. We look at the Bitcoin, Dogecoin, with Elon tweets and all of a sudden things. Behavioral aspects are so key into so many aspects of this. And I think this is something, the quantitative side, absolutely, right? I joke when I say that, look, I don't know, would I do it today? Would I, 20 years ago, it was easy for me to put together a portfolio. I'd run it through Principia and I would actually know where I'm at, and there were fundamentals and it was pretty simple. Today, there's so many things, that drive that. And that's where I do think generative AI can really help, because it can process so much of that. Again, if it's done right under the right behavioral framework, where it's understanding how it comes in and applying some of that to it. But I think there's so many things, and not just the traders, the portfolio managers themselves, but you have the client. And at the end of the day, where behavioral so key is, from the CEO on down to the very first employee the employee at the bottom of the company on up, behavioral factors are involved there. From the portfolio manager, behavioral factors are involved there, and then the individual, the client that they're doing this for, right? At the end of the day, behavioral, and it's not about, and I think a lot of times we look at things from an or perspective, where it's either this or that, right? It's robo or it's advisory. It needs to be, in my belief, and not fact, but it needs to be an and perspective. How can we take the best of both, right, to really drive a better outcome? It's like qualitative and quantitative, right? Some CFAs will no, it's all about fundamentals. Listen, it's like, if you can understand both, that's when you've really mastered that, right? And so I think that's one aspect to look at between those two, how we tie it in, and where I would see the evolution of.
So then my question is what do you tell clients when markets seem to be rational? I'm assuming we try to differentiate the noise from the factual and stick to the investment plan. Is that what you would both suggest, or is what would be your suggestion in that?
I think for me, the most important thing is I think this is where we can use behavioral to our advantage. We spend so much time talking about trying to explain markets, right? Now, I'm not an expert in that at all. I gave that up a while back. That said, even the best trader out there sometimes probably shakes their head and goes, I don't know if I can explain it, right? And so there's basic fundamentals, right? The market goes up or down. There's certain things that we can do to reduce cost basis, to diversify, to reduce risk exposure, all of that. But at the end of the day, less time spent on this, because if, ask anyone on this panel today, it's like, how often do you think about how's my portfolio doing today? And we come from the industry versus what am I doing today? And what's going on? Why did I do this? What's, the conversations we have in our head 360 some days out of the, 365, 366 days is really everything but the portfolio fundamentals. So the better that we can understand the client, how and why they do what they do, and what drives their decision making, again, in a not negative or positive, but just a neutral aspect, the better we can connect that messaging and really not focus. It's first thing I do with my clients, like, look, markets are going to go up and down. Here's where we're at. Here's the time frame. Here's that, right? Let's focus on you. And I joke, it's like I'm the Prozac, if you will, to keep them from being irrational, right? And they're going to be irrational. I'm not going to stop that behavior. That's the thing. Changing behavior, anybody that has kids, it's not easy, let alone ourselves, right? Once we hit the age of 2, who are you to tell me what to do? And so that's another thing I'm not a big believer in sometimes, is changing behavior instantly. It usually takes a major event or therapy or a year's time, right? We can set steps in place. And I think that's one big thing. We talk a lot about choice architecture or client engagement. This is the journey. We tend to do 1, 2, 3, 4, 5, right? Well, if we understand behaviorally how they think, it may be 2, 1, 3, 4, 5, right? And so we align the journey with them, because quite often in financial services, we tend to put people into our box. We don't fit in that box. I mean, I'm probably the first one to say I don't fit into that box, if you couldn't guess by now. But if we can align the journey, so how I align, how I engage, right? Is it an education? Is it a call touch point? Is it a conversation? Is it a review of the plan? Not all of the above, right? And so which one best aligns? And if I can understand behaviorally what motivates them, more importantly, they get it, that's where I can control, right? And I don't mean control from the control them, but I really have that, focus on the journey to be able to improve their outcome, and essentially mine as well.
Don, I have a question. I mean, following what Brian just said, I mean, people getting into the industry are coming in at all different levels. You've got those that are new to Canada, those that are just starting off, they've graduated. You have those that have been in the role for, up to 5 years. And then you have those very tenured advisors that have been, 15 plus years. If you were to look at the different points of those 3 careers, what would you kind of say would be a key thing that each of those groups should focus on that might be slightly different between them, but builds up to where a more tenured advisor with that successful relationship with clients has?
Yeah, I mean, that's a great question. I think it there's so first of all, behavioral can work across the full spectrum of what you just described, right? From someone starting out their career and is in book building mode, to somebody that's kind of going up the curve, and continuing to build on their success, and then of course to the let's say the seasoned advisor. And I think the application is really the key. I think for seasoned advisors, it's a great way to add value in many cases. I think, if we go back to what Brian was mentioning very early on, there's really 3 components to what we're doing in on the behavioral side, right? And that is onboarding, retention, et cetera, et cetera. So we're all working towards that, and that's what I think. Why taking a behavioral led approach really helps, the full spectrum of advisors. And again, depending where you're at and how it's implemented, will definitely lead to the success. And Brian, I'll kick it over to you to kind of provide your insights and thoughts.
In a lot of ways, I actually think now is an amazing time, to get in the business if you're not in the business for this aspect, right? Now, for time and what you have to do, I know those are debatable questions, but the reason why I say that is, we're now at a technology standpoint with what generative AI, with the different tools and solutions that we have, that, the old days I grew up on NaviPlan and profiles where I had to input, well, My assistant had to input everything as soon as I could. We've got hundreds of pages of hard copy documents that they bring in. And today, everything can be done at a click of a button. And so there's a lot of efficiency there. There's a lot of new technology coming out that really finds the source of truth of the data and aggregates it. So there's a lot of improvements. Generative AI can spit out the right information at the right time to us. So I think we're making leaps and bound improvements there, right? The piece and the opportunity is around client engagement. And the reason why I stress that is, over the last 20 some years, we've done this technologically in financial services. The piece that I say we still have an opportunity, I don't want to say it as a negative, is client engagement. I look at here in the US, we just hit over $1 trillion in consumer credit card debt in November of last year. That means we're not doing something right. We're still sitting around the mid 30s for planning, of which less than 50% follow through with that from some studies, right? And so there's still a lot of opportunities. And I think the piece is, as we go from the technology side of the planning, the CRM, portfolio analytics, all of that, that's great. That's the advisor stuff and why the client works with the advisor, to the client engagement piece, and not taking this over to this and calling it client engagement, but really redefining what it means to really approach client engagement. And that's where behavioral can come into play, whether you're a seasoned vet with 20 plus years, and you're looking at, how do I transition my book? How do I, wealth transfer. It's one of the biggest things right now. And unfortunately, we tend to look at it from an asset standpoint instead of a behavioral standpoint. When I make that my junior that I'm going to hire, are they like me? Or is it someone that's behaviorally more like that, and that my books heirs, right? And so that's an area where I see a lot of work being done that we're spending a lot of time on as well too. It's not just looking at, here's who they are, because you have two factors. You have behavioral, and then you also have the values and the likes, right? Obviously, you want the values and the likes, interest and values to align, because if I'm a family guy and you're not, it makes it all difficult. But behavioral, and this is one thing that I've had to really shift myself. Obviously, being a driver, I didn't like working with CFOs or quants because they would drive me nuts. But in reality, that's who should be working with them. Because if you put two quants together, they're going to have the most amazing PowerPoints, but taking action is not going to happen. That's why you need the two of us, and you need friction. And this is what I love. Friction, disagreements, conflict. It's actually now something that we've known for a while, but not wanted to admit, is actually essential to building a strong relationship, right? Both in personal relationships and in business relationships. Because if the three of us go into business today and we all think exactly alike, we think this is good, right? Maybe the first few days because we get along, we're buddies, but we miss out on what exists over here. Behaviorally now, if we can understand how we think and the differences and how those differences actually work, and bring transparency to client engagement on both sides, instead of using this as another, here, fill this out, now I have, information on you, that parent-child relationship. If we get on the level playing field, that's where I think we can make such a significant impact and simplify the heck out of it, because that's easy. You think about it. What do we do with our friends every day? We build relationships and we communicate. That's the easy part. The hard part is the other stuff that's being automated. And so I think that's why I think this next gen and where we're headed is such an impressive time. So,
so one last question, both of you. What would be something quick and easy to kickstart an advisor's behavioral mindset? Don?
Okay. I thought Brian was going to get that jump ball first. Listen, for me, I think my journey kind of started really just reading. I think if you've got an interest in this, the more you can learn and teach and educate yourself about the way investors work and the way people make financial decisions, I think it's absolutely fascinating. And how you go about doing that it is totally up to you, and there's lots of books to start with, and that's kind of the easy approach. And now, not that I'm trying to put the plug in for CSI, but now that you've got the material, I would say that this is kind of a great start to kind of looking at it both practically as well as giving you the academic side. So and just for what it's worth, I have started that journey along on the CSI, and I have seen some of the materials. So again, this was not a plug for Rui. This is coming from me. So just for the record.
Thank you, Don. Brian?
And besides saying, yes, Rui, we'll take I'm just kidding. That was a little bit of a pitch there, right? No, I think it really starts with, how I started my journey, right? is number one is be curious. And I know I think that's easy. We say that, but listen, be a kid. You know, there's so much of value of being a kid. And like I said, it may drive my partner nuts because I refuse to grow up, but be curious and be a kid. Start with that. Second is really stop focusing so much on the outcome, focus on how can I understand my clients better, and really, like as I brought up at the beginning, right? Why do they do what they do? You know, we know the what, but the why, how, when, like really understand that, be a student. I started reading books. Nudge was such an easy read for me back in 2009 when it first came out. It's so dog-eared and everything. And it's written by Thaler, who is, you know, he jokes he's a lazy behavioral economics, PhD. So it's like it was written for me. There's some others thinking fast and slow. It's a very heavy read, but read and just understanding people, right? How to ask questions, how to understand podcasts. I'm a big fan of Standard Deviations and Daniel Crosby. So a quick shout out to him. But he brings on these great, amazing individuals focused on relationships. Become a student of, a lot of us become a student of the actual portfolios, planning, all that. And I'm not saying that's not needed, but become a student of understanding people and the why they do what they do. It's the old thing, put yourself in my shoes, right? That I think we talked about prior. It's like, it's about how do you really do that? So it's put yourself in the shoes without judgment to really understand from this curious way of why, right? And I think we need a lot more of that today, but that's where I would start.
Yeah. And with that, if I can get the next slide. So as Don mentioned, CSI engaged with Behave Technologies to create a behavioral finance in action course. For some of you on this call, this course is already available through your CSI engagement with your L&D department, and you can reach out to your folks and see how to get access to the course. For those of you that don't have this course as part of your learning library from CSI, you can ask your L&D folks to reach out to us and have it included. For those of you that just want to enroll and don't have a program with your current employer, you are welcome to come to the csi.ca website and enroll in the course directly. Brian, I don't know if you want to quickly explain how the relationship between CSI and Behave Technologies kind of builds into this course.
Sure. It is, our R&D PhD team worked together with CSI to really come up with actual actionable applications of behavioral finance. I think that's something as an industry, we've been really good at speaking up here at theoretical level and things like that, but how do we at the ground level apply it? The key piece that I always look at, if we can't explain something at an 8th grade level, we don't know it well enough. And that's really what the course is set out to do. It's not to make you an expert in behavioral finance, to spout out a bunch of stuff, but really to understand from the client side how to better engage with the client. And so I think that's one key piece. That's really what our main focus is around, is helping clients understand how they think behaviorally when they make decisions to improve their outcomes. It's really that simple. So
thank you. Next slide. And we were talking about behavioral finance in action. That is one of the courses on the path to a micro-credential that CSI has created. There is another course that is part of our behavioral finance library. It's called Behavioral Economics for Financial Advisors. For those that complete both of the courses, not only will you earn CE credits that can be used towards your licensing requirements, both on the CIRO side or the CIRO MFDA side, it will also allow you to earn a micro certificate that can be used for social media purposes, something like LinkedIn, Facebook. The badges can be leveraged and used for that. Again, for those of you that would like to learn more, we welcome you to visit us at csi.ca and learn more about the individual courses as well as the micro badge. With that, we are at time. And with that, I'd like to thank everyone for joining. And we look forward to connecting with you on our website, as well as if there's any questions that you feel that were not addressed, please feel free to send them in and we will get to them as soon as we can. And with that, thank you.
Thank you, everybody. Have a wonderful day.
Thank you.